500 basis points at times. So we're looking for clues that we might be in that same kind of period. And what you would see is the short rate being influenced by very strong GDP growth associated with these new technologies, certainly on the unit growth side. And the long bond being influenced more by the deflationary undercurrents that were associated with these new technologies. And of course, we were on the gold standard, so it was not an inflationary world.
Hey guys, welcome to Everyday Finance. Cathie highlights that this rolling recession is more of a rotation than a normal downturn. While some industries, like manufacturing and traditional retail, are shrinking, others, like robotics, artificial intelligence, and genomic innovation, are growing faster. She claims that these changes are a reflection of a profound structural shift in the global economy rather than merely cyclical patterns. She draws attention to the fact that innovation frequently thrives during disruptive times and is counter-cyclical. In fact, she contends that businesses that make investments in game-changing technologies now may end up dominating the market in the future. She observes, "We're seeing the creative destruction that creates the conditions for exponential growth." Cathie discusses the role of monetary policy as well, voicing concern that central banks may be unable to recognize more nuanced signs of economic change due to lagging indicators like employment. Just as innovation is starting to scale, she cautions that over-tightening could stifle it. However, she maintains her optimism regarding the long-term course of high-conviction assets. Her advice to investors is straightforward. Tune out the noise, concentrate on the important things, and embrace innovation. Even though there may be short-term volatility, Wood thinks the businesses that will shape the future are already starting to emerge, and they're doing so during the storm rather than after it. Let's watch the video ahead.
Bitcoin to gold. Gold has had a good run against Bitcoin. Bitcoin did very well relative to gold in 23 and 24, but not so this year. Nonetheless, we do think over time Bitcoin will appreciate relative to gold. And as you can see, it has not broken the uptrend line. Here is the S&P price relative to gold. This is an indicator that Charles Gove of GovCal is monitoring. And he would not be surprised to see the S&P fall as it did in the 70s relative to gold. We would be surprised to see that, especially if we're right on all of the productivity and pent-up demand that fiscal and monetary stimulus should unleash during the years ahead. And the productivity gains associated with it. On the other hand, he would have expected this metric to go down as well, but it is not. The S&P is holding up relative to oil. Oil, of course, is capitulating recently, as I mentioned, because of Saudi Arabia's recent decision. And just a few more charts here. 10-year Treasury yield, we did break the downtrend, and that was a 40-year downtrend. Probably in COVID got to too low of a level, and we would not be surprised to be in a range now for the next few years, 2.5% to 5% range perhaps. But if we see more deflation thanks to the new technologies that are evolving, we wouldn't be surprised to see it settle a little lower than 2.5, but clearly the burden of proof is on us on that one. Here is, from an economic point of view, something that should put all of our minds at ease, especially given all of the consternation about tariffs and and the fear that the equity market seems to be exhibiting. The bond market, this is the high yield spread. It's the spread of high yield interest rates relative to treasury rates, or yields. I should use yields because these are long term. And you can see, while the spread has gone up, and if you looked at it at just a 1 year basis, it has gone up, I think, from 2.6 or 2.5 to roughly 4%, maybe a little less than that. In the context of history, this does not look like a big deal. And so the bond market is not as worried about the stock market, and the bond market tends to worry more about the stock market, more than the stock market, or earlier than the stock market. That is not happening this time. And then finally, just the yield curve. I always like to go back to this and, marvel that even though the monetary and fiscal authorities around the world threw everything they had at COVID, the yield curve could not get back to the steep levels it has seen during past fiscal and monetary stimulus moves. And I just think there is more of an underlying deflation message here, although at the same time you would expect to see high yield bonds being more jittery if this is indeed the case. So we're still wondering about this one. We know there's a message here. The downtrend is still in place. And maybe the message is, and just to end up on innovation, maybe we're going into a time just like the 50 years that ended in the late 20s when telephone, electricity, internal combustion engine were coming of age. And during that time, we were on the gold standard, so there was really no inflation problem. There were boom busts, but inflation was essentially zero when averaged out. But there was a deflationary tendency associated with these new technologies. So the yield curve was inverted. Even during the best of times, it was inverted most of the time, and at an average of 100 basis points. So that would be taking us down to where we were just a couple of years ago, 100 basis points on average, with inversions as significant as 500 basis points at times. So we're looking for clues that we might be in that same kind of period, and what you would see is the short rate being influenced by very strong GDP growth associated with these new technologies, certainly on the unit growth side, and the long bond being influenced more by the deflationary undercurrents that were associated with these new technologies. And of course, we were on the gold standard, so it was not an inflationary world.
According to McGlone's analysis, we might be approaching a new market regime in which conventional correlations disintegrate and capital starts to reallocate in novel ways. He emphasizes that although Bitcoin has proven resilient, it is a lightning rod during times of tightening liquidity due to its historical volatility and speculative nature. He claims that if investor sentiment shifts, the same forces that drove its meteoric rise could just as easily drive a painful correction. The analogy to previous asset bubbles is what makes his viewpoint particularly thought-provoking. Similar to how the dot-com era enticed investors with claims of revolutionary technology, many of which turned out to be untrue, McGlone suggests that the current crypto frenzy may have to face a similar reckoning. However, Bitcoin has already survived several cycles of boom and bust and has maintained a core following of supporters who view it as a hedge against fiat devaluation, in contrast to early internet stocks. However, McGlone is by no means discounting Bitcoin completely. According to him, Its development is a component of a larger movement toward digital value stores, but he warns that the road ahead might be bumpy. He suggests that the next move of Bitcoin will show whether it is actually developing into a macro asset or is still merely a high-beta play riding waves of speculation. We could be entering a phase where price action tests conviction, he writes. The markets are currently at a turning point. According to McGlone, we're going to discover whether Bitcoin is a digital finance revolution or just another risky asset caught in the storm as liquidity becomes more constrained and risk appetite wanes. Watch more.
Now we're on to more market indicators. So Bloomberg's commodity price index, we did this chart earlier this week. I think the Bloomberg Commodity Index has dropped back to 100, and probably will continue to go down if our economy is as weak as we think it is. But as I always like to highlight, the Bloomberg Commodity Price Index is today where it was in the early 2000s, in the early 90s, in the early 80s, which from an inflation concern point of view helps put where we are in perspective. The real inflation was in the early 2000s. For some reason, it didn't get through to the broad-based indicators the way it did to commodity prices. But there is much less inflation now. And now we've got oil prices, the most visible, cracking on us. Here, metals to gold, the purchasing power of gold has continued to go up, as you see in the purple line. So metals relative to gold. When this line is going down, the purchasing power of gold is going up. Gold can purchase more in the way of metals at a given price. Now, this chart doesn't show what has happened today. The 10-year Treasury bond yield did drop below 4%. If we're right on what's going on here, the 10-year Treasury bond yield probably will continue to come down. I know a lot of people speak about China and other countries disgorging our Treasury securities. And from a supply-demand point of view, that is happening, and it is a lack of demand relative to supply showing up. But there is a bit of a flight to safety going on right now, and there's also another phenomenon. I don't know how much it would have an impact on this, but the stable coin movement, those are backed by Treasury securities. And while they're Treasury bills, I'm sure there are ripple effects throughout the yield curve. So the stablecoins are now up to 250 billion, and we expect them to go to 1.4 trillion in the next 5 years. So we would expect the pressure on interest rates in the near term here, certainly because of the economy, to be down, to go down. Here you can see other evidence of rolling recession. The green line here is the manufacturing PMI, and you can see it started going down even before rates went up in 22 in response probably to too much inventories built during the supply shock when companies were double and triple and quadruple ordering. And you can see this measure has been below 50, which means the manufacturing sector has been contracting in the U.S. For several years. It popped up 1 month and now is coming back in. The purple line here is U.S. Manufacturing as a percent of GDP. And you can see one of the reasons President Trump is determined to bring manufacturing back to the U.S. Many people say it's it'll be a fool's game to do that. Because compensation costs here are so much higher, and it will just feed inflation. We have a different point of view on that. We believe that automation with robots, soon more and more humanoid robots, AI, is going to be fertile ground to bring manufacturing back. In fact, it reminded, as manufacturing here in the United States was being gutted, and it went to China, we began to think, okay, how could this reverse? Well, if you think about what happened to China in telecommunications, it did not have a landline system, so it went directly to wireless and became a mobile-first economy, and also leapfrogged us in the digital wallet space. Again, mobile-first. Our financial rails were good enough. It did not have a physical bank branch system, and so it went directly to mobile-first. And leapfrogged us. We're just now moving more into mobile payments in a big way here in the U.S. and in other countries. Well, what if the payback for the last 25 years of losing manufacturing is we leapfrog China and other countries who have older manufacturing techniques that are more labor intensive, and go straight to automation, significant automation, and really it is something we expect, and we do think it will drive significant productivity in the years ahead. So we're more hopeful on that score, to be sure. And more on the rolling recession here. This is year-over-year change in capital goods. It's new orders for non-defense equipment, aircraft and parts on a year-over-year basis. It took a while, but the capital spending has been going nowhere. It's been flat for a good year. And if we're right, given all the uncertainty out there, it could tip over here. So this one is feeding into that rolling recession argument as well.
As Hayes notes, this is about macro triggers colliding with digital fragility, not just about charts or technical patterns. He cautions that global market liquidity is eroding and that quick and violent moves may ensue when volatility hits thin order books. He believes that a cascading reaction that affects different asset classes could result from the US futures market opening at the same time as Asia's Monday trading session. What sets this apart is the global interconnectedness, says Hayes. We're keeping an eye on all of the markets at once, not just one. Concerns regarding leveraged positions and the increasing amount of institutional money in cryptocurrency are also brought up by him. In the event of a flash crash, a sudden move that sets off forced liquidations could have a cascading effect, pulling Bitcoin and other cryptocurrencies lower. Many seasoned traders share this sentiment, becoming more and more cautious on weekends when sentiment is high-strung and liquidity is low. Hayes doesn't sound entirely alarmist, though. He presents the impending occasion as a possible reset, a high-stress moment that could distinguish sincerity from hype. He emphasizes that tumultuous times like these frequently precede revolutionary shifts in market structure and long-term positioning, saying true believers will be tested. In the background, social media feeds are crowded with speculation rather than joy. Exchanges are abnormally quiet, and retail investors are silent. The silence before impact is a rare pause. One thing is certain, regardless of whether Monday brings a market meltdown or a false alarm, The maturity of cryptocurrency will be determined by how well it handles adversities like this, rather than by bull runs. Thanks for watching.